check with Pankaj. I don't remember any large approval has come over the weekend for NATCO. If it is, I must have missed it. We'll tell Pankaj to fill us up on this one. All right, Aditya, good morning. Thank you for joining us. Why are markets so strong? It should have been the other way around, because the earning estimates for FY22 have got seriously challenged because of the medical crisis. But looking at the market levels, markets are saying there is no there is no concern in the world.
Good morning, guys. So I'd say there's a combination of factors, right? I think as a backdrop, you've got the global economy doing well, you've got global markets doing well, and that is feeding through to earnings as far as India is concerned and the export cycle. So I think that is one thing that's playing through. I think the second thing is just visually you are tending to see, the easing of the second wave. So that is something that markets will typically play. You saw it in the first wave also, where the initial part of the peaking off tends to fundamentally play through, right? And the third thing is, while there will be some risks to earnings from a demand perspective, I think what this quarter is demonstrating is that on the cost side, guys are still doing reasonably well X of the imported costs. So I think that combination is giving you a certain amount of boost. That said, you've got to be a little watchful, because as you said, I think the demand outlook has clearly faltered over the last month or so. And it's not just a question of the demand that you see in the very immediate term, but something that could be extended to 3 or 6 months. So I think, in many senses, there is a reason for support to the markets, but at the same time, there should be the caution that you mentioned, that you have slipped back a little bit more in terms of the demand outlook.
Where do we go from here? Go with global sectors, because global economy is in a much better shape on the medical front and also on the policy front, or go to Indian sectors which have a scope of surprising us with a comeback, whether it's cyclicals or industrials?
So quite honestly, I think it has to be a combination. From our perspective, I think the global side is a little bit of a gimmick. You are seeing it in terms of the economic momentum they are seeing. You're seeing it in the dropping of the infection rates, and you're seeing it in the pace of the opening up. So I think the global is an underlying theme that is going to sustain for a while. On the domestics, our bias is much more on the cyclical side. No doubt the fact that the next couple of months could be a little watchful. But for us, I think it is the cyclical side that should be pushed on more, whether it is the balance sheets of banks. And, earlier in your show, you were talking about how SBI has done and how the PSUs are tending to run, right? Or whether it's the industrial cycle, which I think will be less impacted by what we're seeing on the demand side or on the lockdown side than the pure consumption side. So I think it's that combination, actually. I think the global, has been an underlying theme. I see no reasons for that to trip up. In fact, you're seeing the US's momentum now is beginning to push through to Europe also. Likewise, on the domestic side, I would tend to bias more on the cyclical side.
Okay. What are the parameters, Aditya, that you're also looking at then if you're eyeing those cyclicals? Is it more to do with growth-oriented stocks? Would you be looking for, would you say the value question currently perhaps is taking a back seat, given that some of the sectors that have really seen a run-up in the last year or so are trending at pretty high valuations right now and perhaps have taken a bit of a back seat for the moment? So would it be growth versus value at this time?
See, I think at this point in time, the two distinctions have become less, because one, there is very little which is absolute value other than the banks to some extent relative to their historic pasts, right? At the same time, I think other than a few selected sectors, and those also are more globally linked, I don't think you have very high growth sectors, because at the end of the day, the growth paradigm is going to be, it's going to be good from a base effect, but otherwise it's going to be a little bit more muted. So I think splitting it up into a growth versus a value kind of framework, I think at this point in time is neither as distinct, nor does it make that much sense. I think the bit between consumption and investments, I think that is more pronounced, and our bias would tend to be on the investment side. We do see upfront risks to consumption demand, and this could be a little longer stretch than what the market might be extrapolating at this point in time. Likewise, we believe that that the investment side, because there is liquidity, because there has been a little bit of policy support, and because markets have been supportive, so capital is not that much of an issue, I think the investment side will tend to do a little better. I also think one of the things that one has to look out for is in terms of incremental policy as it comes from the government, on whether firstly you get any additional support, and secondly whether it is more biased towards the investment side or towards the consumption side. And while I don't think it will be necessarily very stark or very, very discrete, I do believe that given that you've seen infrastructure issues on the health side, given this pandemic, I would tend to believe some of the policy response will tend to come in areas of investment and capacity creation. And that too should play through better to the investment cycle or the industrial cycle rather than necessarily the consumption one.
Okay, on the financials, how would you slice and dice that area? Stick to the preferred private names, go a little deeper into the segment, NBFCs, what in particular would you say is an attractive opportunity right now when it comes to the financials basket?
I would look at it is there are two elements to look at from a financials stock, right? One is what's happening on the balance sheet, the other is what's happening on the P&L side. And I would tend to believe at this point in time, the positive balance would lie on the balance sheet side, where asset issues are tending to ease, liquidity is there to support, and quite honestly, balance sheets have been supported by provisioning that a lot of the banks took in the first cycle, right? So I would tend to believe the balance sheet plays would tend to still dominate in this cycle at this point in time. I think as far as the P&L side is concerned, which is where a lot of the NBFCs come through, I would be a little bit more cautious. That's a turn that you definitely require. You do need loan growth to go up. But at this point in time, I would tend to believe it is going to be a little slack for a period of time. So very well-valued, high-growth kind of entities are not necessarily going to be where the return will lie. It will tend to be where there is a little bit more of a balance sheet fix that's happening. So in our view, it's a kind of space where you don't have to play absolutely at the top from a quality perspective or from a growth perspective, and you don't have to play absolutely at the bottom, which is where all the risks tend to rely. It's somewhere in the middle where you have balance sheet kind of banks which have suffered a little bit but are on the way on the mend, and that itself gives you a pop. So what you've seen with SBI with the results and the way the stock has responded, I'd say that would be the territory to play through. The NBFCs I'd watch a little bit more because, as I said, the bulk of them at the end of the day, the great value that they get is when there is a lot of P&L momentum, and you're not tending to see that at this point in time. I think one other thing that I'd want to highlight is that, very often a lot of people start looking at the margin outlook. I'd say there you are in neutral territory. I think while banks will not have material pricing power, I think liquidity is also relatively easy. So to that extent, that's going to be a less influential element in the playthrough. So bottom line, take on a little bit of risk with the banks, play them for the balance sheet, don't chase the P&L at this point in time.
Right. Aditya, while metals have had a dream run for over a year now, how do you explain what's happened in the metal stocks in the last 1 week or so? Just froth easing off, or would you say they've topped out in the near term? And add to that, data points like what one is hearing from China, for instance, this morning, wherein they vowed zero tolerance for commodity future violations, and which is why you're seeing metal stocks globally as well correct.
So I think there are 2-3 elements at play as far as the metal space is concerned, and I'll tell you our fundamental view. Our view, we've been very positive on it for the bulk of the last year. About a month or so, we went neutral at a portfolio level, at a strategy portfolio level, simply given the fact that these stocks had run up very, very aggressively, right? Now, some of the response that you've seen with these stocks has been really driven not by demand, which has obviously been good, and pricing that has supported it. But I think the regulatory changes that you've seen. So on the one hand, you had about a month or so ago, this clampdown in China for a lot of smelters and for going more green, which gave you an extra leg in terms of prices, and therefore stock prices went up. and now you have this corresponding, pullback. So I think you got into a territory where the price environment is going to be higher. So you are going to see decent earnings for a lot of the metal space play through. But I think the volatility around expectations, particularly from the policy front, will actually tend to remain high. And that would tend to mean that these stocks will not necessarily come off materially from where they are. But the risk-adjusted call that one needs to make, I think that becomes harder and harder. So I would tend to believe a neutral kind of stance would really be the best at this point in time, because the drivers are non-economic, right? More policy-driven, and also policy-driven in China rather than across the world, or something that you can make a call on or see in India, right? So I'd stay kind of neutral. I think you will just have these gyrations, but I would add that the underlying price sustainability is reasonably high. And so the earnings outlook will tend to be reasonably robust for them.
Right. Aditya, I have to ask you this, maybe a little outside your domain, but how is it that you're reading into the volatility that one is seeing in the cryptocurrency world? The fact that Bitcoin is now sub 32,000, is that in any sense giving you a feeling that investors globally at large are turning a little bit risk averse?
No, I wouldn't say so fully, but I'd say the riskiest investors, the investors at the margin, I think they are tending to swing a lot, right? So I think what has changed with the pandemic is that you've had a newer class of more active investors who've come into the market, and at the margin they have created, they've lent a lot of volume to the market and a lot of volatility to the market. So I think about 6 months ago it was on the S&P and the NASDAQ the way it moved, right? And then you had some levels of correction and volatility. Now it's moved on to the Bitcoin territory. So I would tend to believe that the riskiest investors are moving up and down quite substantially. I think the core of the institutional investors that you are seeing, I don't think the swings are as dramatic. So I think a base level in base asset classes will tend to continue to show the kind of performance it's shown, and by and large hang around the same levels, right? So and that's again, it's not something that I track very directly or I'm very into it, but I think what has happened is from an asset class it's at the margin, and since there are a lot of marginal investors in the market at this point in time, you're tending to see a fair amount of volatility around it, but it will also tend to reach a certain level and tend to stabilize.
Well, I really appreciate your time. Glad you could join us. Gives me great pleasure to bring on board now Mr. Ashwini Bhatia, Managing Director with State Bank of India. Mr. Bhatia, SBI numbers in last